Okay, so we've got three speakers here who are going to talk on different subjects, because what I wanted to do was talk about regulation in the morning, primarily, although we will talk about greenwashing communication later. And I wanted to just get fund managers to talk about some of the good stuff, because there's enough bad stuff around, right? So let's hear some stories then. We've got 6 fund managers doing this. I've split you into 2 groups of 3, so you don't listen to the load people back-to-back doing the same thing. But I'm going to just ask you to each speak for 6 minutes, please, if you can, on your chosen subjects. And I've got Duncan down first, and this is reference, obviously, to what you do in your day job. But the title of this session being Don't Ignore the Improvers.
Absolutely. Thank you, Julia. It's been a pleasure this morning to listen to some genuine experts talk on their chosen subject. I apologize that now you're getting me. But it is only me for 6 minutes. I've got 6 minutes to convince you that investing should be forward-looking. And you're probably thinking, well, yeah, obviously. Even in our own ISAs, we don't buy companies because they're achieving the peak of their powers. We buy companies because they're improving their margins, or the revenue growth expectations are expanding, or they've developed a new incredible obesity drug that George is going to talk about in a bit, and that's going to transform their business. We are naturally forward-looking, and we assume when we're buying a company that the market isn't yet fully valuing that future potential. So far, not a lot of controversy from Duncan, but this is a sustainable investing conference. So let's ramp up the controversy a little bit. Why don't we always take this approach in sustainable investing? And more specifically to my job, why don't we always take this approach in impact investing? Exclusion policies, minimum of 10% from coal, maximum of 10% from coal, depending on which way around you look at it. That's very much backward looking. What about the company that goes from 12 to 8? Negative screening. You're relying on ESG data, which is getting better at being forward-looking, but for the most part is backward-looking today. And in impact investing today, we mean positive impact when we say the word impact. We're only investing, and I'm looking at my notes here because it's the GIN definition, we're only investing in companies whose products and services have a positive impact on society and the environment, positive company impact, and through that, we, as investors, have a positive investor impact. Do no significant harm. Avoid harm. We've all heard these phrases very regularly. And so, perhaps rightly, you don't see many oil companies or legacy utility companies or mining companies in an impact portfolio, in a positive impact portfolio. Let's talk about real change. Is the world going to change? Are we going to achieve the sustainable and more equitable world targeted by the UN SDGs or targeted by well-meaning positive impact fund managers without miners, without utilities, without, even in some cases, oil companies? You cannot make a zero emissions EV without the battery that needs cobalt, nickel. The grid companies are going to have to spend $21 trillion by 2050 on expanding the grid to accommodate the new renewable generation if we're going to hit net zero, according to Bloomberg. That's going to be a lot of copper and a lot of steel. And you can't even make the wind farm without steel and without concrete. So we're just not going to get there without these companies. I'll give you one more example, one more very specific example. An oil services company that through its legacy oil business has developed compression technology. And that compression technology has a 90% market share in LNG compression today. So you could argue, and the EU taxonomy does, that that's a transition fuel, but let's not go there. Let's instead focus on what we're going to need that technology for in the future. Carbon capture, first of all, it's already happening. They're already getting orders in that business. Hydrogen, the great hope that's supposed to replace natural gas, but actually is the least energy-dense gas around and therefore needs more compression technology. So should we be excluding that company because it's in the oil and gas sector? Or should we be owning that company because it has the potential to change. In short, sustainability is a whole economy problem. All companies have company impact. Some negative, sure. Some positive with negative externalities that we have to take into account, because we shouldn't ignore the negatives just because we're talking about the positives. And then, of course, there's those that are improving their impact, the improvers. And don't forget as well that even positive companies can improve. So if we want to drive real change as investors, we want to play a role, our role in that value chain, we would argue that we should actually be trying to avoid exclusion policies, or at least allowing bottom-up exemptions to those exclusion policies. We should be forward-looking, in short. And then we should be engaging, being active, again, playing our role to drive that improvement. So with that in mind, should an impact investor ever invest in an oil refinery? Now, obviously, I've given it away with where I'm going with this, but I want you all to say, no, of course not. Article 9, do no harm. But what if that oil refinery that we're discussing here is Neste's oil refinery in Finland, and we're winding the clock back to 2011? Because in 2011, sure, Neste's oil refinery was refining fossil fuels. But between 2011 and 2021, Neste provides us with one of the best examples, sure, an extreme example, but one of the best examples of a company that transitions its products and services to be aligned with the sustainable future. Because now, Neste is the world's largest provider of biodiesel. Same assets, different feedstock. Many people would argue, despite potential negative externalities from water use or biodiversity from the feedstocks for biofuels, but most people would argue that biofuels would be perfectly at home in a positive impact portfolio. But if you're a sustainable investor, you couldn't buy Neste until it had less than 20% from oil and gas. If you're a positive impact investor, you had to wait until it did no significant harm. Most of that came after 2021. Between 2011 and 2021, when the transition was happening, Neste's shares were up 2,000%. So if we can be forward-looking in our sustainable investment, or in the narrower field of impact investment, we can not only benefit from positive impact from the companies that are aligned already with the sustainable future, the ones that we were talking about this morning, where you're seeing a long-term structural trend and we can benefit from the higher returns that those companies generate, the compounding of those returns over time, and maybe the fact that those higher returns are underappreciated by the market. But if we can be forward-looking, we can also benefit from those companies that are improving and the valuation re-rating that they get in the market from that. And that leads to my final point, diversification. Impact investing today does tend to be focused on positive impact stocks. Obviously, we've said that. Growth, low capital intensity, high exposure to tech tends to mean developed markets as well at the moment, and that means sector and style bias for investors. By being forward-looking, we can have utilities, we can have energy, we can have mining, obviously we can have financials, the more value sectors. And that means we can bring this fabulous concept of impact that we know that clients want to see into the wider world of global equity investment. So my message to you is don't ignore the improvers. They're probably the ones that are actually driving the change. They could be the ones that are driving the outsized alpha, and they're the ones that allow you to think about impact in the wider context as well.
Thank you.
Thank
Brilliant.
you.
And fits very well with our icon of the dial, saying, we need to move that way. We're not necessarily perfect, but we've got to get there. George, please, if I can ask. We've now got George from Royal London, who's talking about a subject that worries me slightly, introducing innovation in weight loss drugs.
Yeah, something very different from this afternoon, but I think one of the most exciting investment opportunities there is, and really a way to help evolve our healthcare systems for the positive. I'm just going to start by setting the scene. As we all know, we live in a globe with a globally aging and growing population. In fact, by 2050, the number of people over 60 is going to double to 2 billion. And at that point, 1 in 6 people on the planet will be over the age of 60 as well. Not only do we have this growing and aging population, but this is causing significant demands and pressures on our healthcare system, where we've got this model where 50% of deaths now come from cancer and cardiovascular-related diseases. And part of the issue here is that we have a healthcare system that's really designed for, it's really reactive in its nature. Things get diagnosed, you then get given medicine, and then you have to manage that condition the best you can for the rest of that person's life. We need to evolve to a more preventative system. And I think weight loss drugs are part of the solution here. So the other big problem happening in the world is the growing obesity crisis. So it's not only the United States, although that's certainly the most important market from an investment perspective today, but it's estimated that around 100 million people in the United States are considered to be obese. And that number could be anywhere up to 800 million people globally today. Depressingly, that number has not decreased for 2 consecutive years since the 1970s. And this does seem to be a crisis that is very much spiraling out of control. The good news, however, is that we've got this new category of drugs called GLP-1s, which are proven to be able to help people reduce their weight by anywhere between 20 to 30%. And they work in a very novel mechanism by working with the brain receptors, which basically convince you that you don't want to eat anymore. However, I don't think that just helping people lose weight is really the big opportunity with weight loss drugs, although it is estimated that around 100,000 people in the United States every year die from obesity and diet-related conditions in itself. The real opportunity comes from all of the comorbidities associated with weight loss, with weight, and people are being obese. And we're really scratching the surface in understanding this. Things like cardiovascular disease, heart attacks, strokes. We've seen early clinical studies suggesting that these can be reduced by about 20% or so by helping people manage their weight more effectively. And there's over 30 clinical trials in current stages looking at other things like kidney disease. And diabetes is another comorbidity that it's already being proven to help reduce meaningfully. So we think it could be one of the biggest new medical addressable markets we've ever seen, just in terms of number of people and the way that the market is evolving. And healthcare systems are increasingly around the world getting on board with it. And we're incredibly early in this. Although there's 100 million people who are considered to be obese in the United States, only about 4 to 5 million people in the United States are getting medicine for it today. So we see a very long runway for growth and think it's a very exciting part of the healthcare space to be invested. I'll wrap up there.
Thank you very much. See, there are growth areas that are doing good, and this is exactly the kind of thing I wanted. Thank you. These are opportunities to look at things differently and recognise the opportunities too. Jeneiv, if I can ask you to please talk. We've got another really, really interesting subject. And this is great that I didn't prompt fund managers on anything at all. I just said, talk about something you find interesting, something good. And we've got making plastic circular. What a good topic.
Great, thank you, Julia. Good afternoon, everybody. So I'm going to start by giving you 3 dates. November 11th, 1981, September 30th, 1996, and August 1st, 2024. So you're probably wondering, what's this got to do with plastics? Well, there's one thing that connects all of them. All those dates are known as Earth Overshoot Day, and that's calculated by the Global Footprint Network. So that's the day when humanity's demand for ecological resources in a given year exceeds what the world is able to regenerate in that year. And as you can see, it's getting shorter and shorter and shorter, so closer through the year. But what really should worry us all is quite how much of the Earth's materials we extract, process, convert, and then use are actually wasted. In fact, some of the estimates are close to 90%. So I wanted to dig into one particular material that we use every day, plastic, and try to understand whether it can be made circular. So plastics are long-chained polymers made from fossil fuels, and the demand for them has increased 20x since the 1960s. So we now produce more than 400 million tons per annum. It's popular as a material because it's very durable. It's flexible. It's versatile. It has barrier properties. and it's very cheap to produce. But unfortunately, these are also the Achilles heels for plastic. In fact, it can take over 400 years for plastic waste to decompose in the natural environment. And even then, there's all sorts of toxicity issues with that. The main use for plastic is packaging, 40%. Second most biggest segment is buildings and construction, 20%. But what will surprise you is only 9% of plastics are recycled, according to the OECD in 2020. A further 16% are incinerated, and 50% end up in landfill. So we really need to do something about this. The life cycle emissions for plastics alone account for 3.6% of global greenhouse gas emissions. So that's just one material only. So it's not just a climate carbon problem, as you know, well documented by Sir David Attenborough and Dame Ellen MacArthur. It's also a hazard for wildlife. So what can we do to prevent or reduce the harmful externalities for the planet, and how can we try and make plastic circular? Well, on the supply side, we can look upstream at the methods of plastic production, and downstream, we can look at things like waste capture, recycling, and reuse. Alternative forms of plastic can alleviate a lot of the waste. These are known as bioplastics, I'm sure you've heard of them. They use raw biomass as raw inputs, things like sugar or other crops, organic waste such as compost. But really, they're tiny. They actually only account for 1.5% of all plastic production. And even if that's going to grow, which is projected to reach 10 million tons in 2028, it's a tiny dent in the supply side. And not only that, there's a bit of a myth about some of these bioplastics. Not all bioplastics are biodegradable. There's actually a difference between the two. So let's sort of dig into recycling the other end, downstream, a little bit more. So there's two main methods. One is mechanical recycling. It's actually the most common. That's where you crush and melt plastic that's waste from waste streams, and then you turn it into granules, and that can be reconverted into new plastic products. Typically, a lot of them are for less valuable products, non-bottle related, for example. But this is hampered because there's not a lot of integration in the whole value chain for recycling. And collection's not really done by the people that crush and smelt. And on top of it, you get contamination issues. So really, that's not a solution on its own. There is a second approach. It's at an early stage. It's to use chemical recycling. This is where an enzyme can split the polymer chain into its molecular components. It can be used in conjunction with mechanical recycling to increase the recycling rates in general, and it prevents a lot of plastic being incinerated. It can also be used in a circular system, where new virgin biodegradable plastic can be created from the output. The only limiting factor is that the process is highly energy intensive, and up till now it's been very difficult to scale up. So there's one company that I've been following which is making quite substantial progress. They're using a protein-based enzyme recycling method. The company's called Carbios. It's publicly listed in France. It's partnered with Novonesis, which is a global manufacturer of enzymes. And the two of them are working together to try to break down specifically PET bottles, which are commonly used for bottles, plastic trays, and even in cosmetics. The life cycle carbon emissions are reduced by 90% when compared to virgin hydrocarbon-based plastic. Carbios has just finished completion of its first 50,000-ton capacity plant, and it's partnered by many global consumer companies, so examples like L'Oreal, On Running, and Patagonia. We hold Novonesis in the Food and Agriculture Fund at Sarasin because we think they have an important role as an enabling partner with the enzyme, and I'm also keeping an eye on Carbios to see if they can license their proprietary technology to downstream chemical companies. So making plastic circular is not an easy problem to solve, and will require society to really work at different levels of the value chain, both upstream and downstream. And they'll have to do it simultaneously. I hope my example of a small company like Carbios will give you some confidence that there is capital out there trying to solve what is an increasingly and very important, valuable mission. Thanks.
Fantastic. I'm going to keep going with this kind of session. This is so interesting. This is just so different and different perspectives. And when people talk about wanting to standardize everything in this industry, this is why I'm kind of like, no, we don't want to kill innovation. Let's keep our eyes open. Don't put the blinkers on. There's so much yet to be done that we haven't thought of, that people don't know about. Let's explore it. We've just got literally a couple of minutes for a few questions. If anyone would like to talk about improvers or weight loss drugs or plastics, can I throw open the questions? I'm hoping there are some mics around somewhere. George, Hannah, you? Mic at the front. Uh-oh, look out.
No, I really acknowledge the real-world expertise of the panel. And there's a lurking public policy issue which would support all those things. And I'm going to ask the question this way. Does the panel agree with me that net zero is a public policy goal and not a goal for the investment industry? Because the focus is on policy supporting good investments. So does the panel agree with me that net zero is a public policy goal and governments have over-delegated to finance the government's role of shaping markets?
Government's responsible for setting the framework, aren't they? But yeah, would you like to pick up on that, George?
That's always a danger with going first with a tough question.
Sorry, you were nodding. I'm sorry.
I mean, I think change happens fastest and most successfully when everyone's aligned, and where you see the most positive progress is where governments and the corporate sector are doing the same thing essentially. And I think agreeing on appropriate timeframes from both is really important as well to success. But yes, I think it's very difficult to do something like net zero without that coming from policy level, to be honest.
I fully agree. And we've seen actually that the rhetoric from policymakers is not always matched by the actions from policymakers. It's not always the policymakers that you think are driving this that are actually putting the money where the mouth is. Look at the IRA in the US, for example, which has been and will continue to be, whatever happens politically, a huge positive driver. I'm not sure that they've over-outsourced to us. I think we are part of that value chain, and we have a responsibility as investors to play our role, as do companies who, at the end of the day, are the ones that are doing 99% of the emissions that we account for as asset managers.
Do you have anything to add, or should we take another question,
please? I agree with Mike and both panelists. Yeah, I think this is, I think you need leadership from government on this, and public policy is a big driver behind the ability for private capital to flow into the right areas. So, yeah.
Fantastic. Thank you. And it's such an important question. That's why we keep talking with regulators and we keep talking with government. We push stuff through together, right? That's why you don't step back and wait for other people to do things, because often we know stuff they don't. One more very quick question, if anyone's got a burning question. Or can you wait for your mic? Sorry, just so we can catch it on the camera. Yeah, not that you need one, of course. Richard,
is there
voice.
Any sort of investable asset within sort of reuse within listed equities? I mean, because the circular economy is going to be something we're going to have to embrace. I just wondered, I know it's very early days, but is there anything sort of out there which potentially you could invest in?
That's a great question. There's so a couple of examples of businesses that are still in the private side that have emerged over the last 5 or 6 years are ones where we sort of recycle clothing, for example. Now, none of those have become publicly listed, to my knowledge. There are also other companies that are looking at making sure that we reduce food waste in the value chain for, again, making sure that food that is able to be eaten by humans but is not thrown away is then sent to charities and shelters and places like that. But again, all of these tend to be in the private venture capital space still at this point.
There are examples where it's part of a wider company, where the big companies are taking a lead on this. If you look at the construction space, for example, some of the insulation material companies, Kingspan, Carlisle, it's a US-listed one, Kingspan, Irish listed. They're trying to recycle more product back in to the value chain, and then allowing more of their product to be recycled in the future. So you're getting that sort of double circularity approach. Within fast fashion, since you mentioned it, Inditex is probably the best of a pretty awful industry, but really trying to lead that industry forward in reuse.
Thank you. I'm desperate to ask a question about Vinted, because knowing some of the younger folk here, George and Charlotte, my kids, and Hannah, Vinted obviously is the obvious one to go, that's amazing. But hoping maybe they'll come to the market one day. I'm guessing they're not, are they?
They're not publicly listed. Yeah, I think pure plays are harder to find. As Duncan said, there are companies that are trying to do better within their whole operations, but nothing that's pure play, as far as I'm aware.
Okay, and with that, I'd like to thank the panel, and we'll move on. Thank you. Thank you so much.